Chapter 3 Mutual Funds. Mutual funds. Asterisk meaning and features of MF. For asterisk history of MEWVE. Benefits and drawbacks of investment in MF. Asterisk major fund houses in India. Asterisk types of mutual fund schemes and plans. 2017. Asterisk Systematic Investment Plan, SIP, of MF. Asterisk Systematic Transfer Plan, STP, of ME. Asterisk Systematic Withdrawal Plan, SWP, of MF. Net Asset Value, VA, Simple Problems. Features of mutual funds. Meaning of mutual funds. Mutual funds is a pool of money collected from a number of investors and invest in equities, bonds, or other securities. It is managed by a professional fund manager. The features of mutual funds are as follows. 1. Low cost. 2. Properly regulated. 3. Easy purchasing. 4. Investment flexibility. 5. Professional management. 6. Portfolio diversification. 1. Low cost. Mutual funds charge a small amount known as the expense ratio from investors. It is charged to cover only admin, MOCT, and other expenses. 2. Properly regulated. The SFBI regulates the mutual fund market. Mutual funds have to strictly follow SEBJ regulations, 1996, to ensure transparency and protection of investors' wealth. 3. Easy purchasing. There is options of offline and online purchasing of MF, where entire process is easy, and in online if is convenient and fast. 4. Investment flexibility. MF offer flexibility. You can either invest a large lump sum amount in the beginning, or regularly invest small amounts in the form of a SIP. 5. Professional management. Mutual funds are managed by professional managers who do complete research and analysis of the market and monitor portfolio and its performance. 6. Portfolio diversification. Investing in mutual funds gives opportunity for diversified portfolio containing different types of equities and other options. The 15th of March 2023, 7:19. Stores. Penses. Page not. History of mutual funds. Mutuo meaning of mutual funds. Mutual funds is a pool of money collected from a number of investors and invest those money in equities, bonds, or other securities. It is managed by a professional fund manager. History of mutual funds in India. 1. First phase. Phase of inception 1964 to 1987. Asterisk mutual funds industry started in 1963 with formation of UTI and control by RBI asterisk unit scheme, 1964, was first scheme launched by UTI asterisk UTI was delinked from the RBJ and IDBI. Took over control, in place of RBT. Company at the end of 1987, UTI had 6,700 crores of asset under MOCT, AUM. 2. Second phase, entry of public sector, 1987 to 1933. Asterisk non-UTI mutual funds from public sector entered the market. It was established by public sector banks, LIC and GIC. SBI Mutual Fund was the first non-UTI mutual fund, followed by Canbank MF, Punjab National Bank MF, Bob MF. At the end of 1933, the MF industry had 47,004 crores of AUM. 3. Third phase, entry of private sector, 1933-20-2003. Asterisk A new era started with entry of private sector, giving investors wide choice of funds. Asterisk all mutual funds SEBI were registered under in 1996. SEBI regulations were revised and replaced with new rules. To all mutual funds except UTI. At the end of 2003, there were 33 MFs with 21,805 crores of AUM, out of which UTI alone had 44,541 crores of AUM. Fourth phase, phase of consolidation, 2003 to 2014. Asterisk in 2003 UTI was split into two separate entities, UTI Mutual Fund, under SEBI specified under or taking of Unit Trust of India SUUTI, under Indian Gov. Asterisk with the bifurcation of UTI and several mergers taking place among DLF private sectors, Paramir, the MF industry entered its fourth phase of consolidation. Since fifth phase steady development and growth, 2014. Asterisk since 2014, the MF industry has experienced a steady inflows and increase in the AUM as well as the number of investor portfolios, accounts. The MF industry's AUM has 7 trillion, 7 lakh crore, as on 2012 to grown from 38 trillion 38 lakh crore, as on 2022. Since asterisk on an AVG 12 lakh new portfolio or every month last SYRs, the 15th of March 2023 720. Page No. Benefits of investing in mutual funds. Meaning of mutual funds. Mutual funds is a pool of money, collected from a number of investors. Invest those money in equities, bonds or other securities. MFS is managed by a professional fund manager. The benefits of investing in mutual funds are 1. Liquidity. 2. Managed by experts. 3. Low cost for bulk purchase. 4. Safety. 5. Less risk. 6. Automated payments. 1. Liquidity. Open-ended mutual funds are highly liquid. Units in these funds are easy to purchase and it is equally easy to exit from the scheme. Port 270 TASI. Co. 2. Managed by experts. Investors need minimal knowledge about mutual funds to invest in them. Professional managers do all the work on behalf of investors. They make good decisions. 3. Low cost for bulk purchase. The higher number of mutual fund units are purchased, the lower the cost and there will be lower commission charges and processing fee. 4. Safety. Its operations come under SEBI and necessary disclosure has to be made, which makes trading safe and transparent. 5. Less risk. The professional fund manager invests the money across various stocks of companies and manage mutual fund. This makes less risk. 6. Automated payments. Sometimes, you may forget to pay SIP amount on time. So, automated payments can pay directly on a certain date each month. Drawback of investing in mutual funds. Meaning of mutual funds. Mutual funds is a pool of money collected from a number of investors and invest these money in equities, bonds, or other securities. It is managed by a professional fund manager. The drawbacks of investing in mutual funds are: 1. Penalty. 2. Cost. 3. Fluctuating returns. 14. Diversification. 5. No intraday trading. 1. Style. Date. Page not. 1. Penalty. In some mutual fund, if investor want to exit before the stipulated time, they have to incur exit charge. 2. Cost. The salary of market analyst and fund manager comes from investor along with operational cost, which may increase overall cost for investor. 3. Fluctuating returns. According to market conditions, mutual fund returns keep fluctuating, and investor to be aware of a risk profile before investing. 4. Diversification. Even it can reduce loss, it can prevent from gaining significant profits. 5. No intraday trading. In mutual funds there is no intraday trading. Mutual funds are traded once per day. The 15th of March 2020. Types of mutual fund plans, schemes. Meaning of mutual funds. Mutual funds is a pool of money collected from a number of investors and invest in equities, bonds or other securities. It is managed by a professional fund manager. Schemes. Types of mutual funds plans are: 1. Based on their structure. Open-ended scheme. I. Interval scheme. Asia. I. Close-ended scheme. 2. Based on assets classes. I. Equity. MF. BERT. UK. 2. Debt. 100. Hybrid. Manon. IR. Solution-oriented. MF. 3. Based on investment objectives. I. Growth fund. I. Income fund. Money market fund. 4. Based on portfolio management. I. Active. Me. 1. Passive. MF. Date. Pape. Nay. 1. Based on maturity period. I. Open-ended schemes. You can invest and redeem your investments whenever you want. There is no fixed time, so more liquidity. MF. 11. Close-ended schemes. Close-ended MF schemes have a stipulated 18F have a maturity period of investment period. I. Interval MF schemes. Interval MF schemes allow you to invest, or redeem from them, at intervals. 2. Based on asset classes. 1. Equity MP. These funds have high market risks as well as potential to generate high returns. E. Debt MF. Debt funds are minimum to stock market risks and offer relatively stable returns when compared to equity funds. P. Hybrid MF. These funds invest their portfolio in a mix of different asset classes like equity, debt, etc. IV. Solution-oriented MF. These funds invest to create a specific financial need. Planning for a child's education. 3. Based on investment objectives. I. Growth fund. These funds invest in growth-oriented assets and investment require medium to long-term investment horizon. I. Income fund. Income funds are regular and steady income to investors, and these invest in fixed income securities, like corporate debentures, bond etc. 1. Money market fund. These are options for investors seeking liquidity and protection in commercial returns. 4. Based on portfolio management. 1. Active mutual fund. In this, the fund manager is active buy, hold or sell in deciding whether to. 1. Passive mutual fund. Passive MF. Those are wherein the fund manager does not actively manage the portfolio. The 15th Page No. Mutual fund houses in India. Meaning of mutual fund. Mutual collected from a funds is a pool of money in number of investors and invest those money in equities, bonds, or other securities. MF is managed by professional fund manager. A. The mutual fund houses in India are 1. SBI Mutual Fund. 3. SBI Equity Mutual Fund. 3. ACC Mutual Fund. 4. HDFC Mutual Fund. 5. Reliance Mutual Fund. 5. Franklin Templeton MF, Street. 7. Birla Sun Life MF. 8. UTI Mutual Fund. 9. Kotak Mahindra Mutual Fund. 10. Axis Mutual Fund. Benefits of Systematic Investment Plan. Meaning of SIP. SIP is a plan of mutual fund where a person, instead of making lump sum investment, can invest amount at regular intervals. A fixed. The benefits of SIP are 1. SIP is best option for the people who do not have knowledge of finance and do not know how market moves. 3. In SIP a person can invest a fixed amount at regular intervals, instead of large AMT at one shot. 3. ARSJP a person can buy more WITs when market is low and buy less when market is high. To just Savolg. 9. In SIP the small amount invested can grow daily up to a large BC of sum of your contribution. 5. In SIP, a person can start investing with an amount as low as 100 per month. 3. In SIP, it removes the time need to invest in the market. The Dato. Page No. Systematic Transfer Plan, STP, ME. Meaning of STP. STP is a mutual fund investment strategy in which a predetermined amount can be transferred from one scheme of MF to another scheme of ME at predetermined intervals. The systematic transfer plan of MFE benefits are 1. High return. 3. Optimal balance. 3. Averaging of cost. 9. Taxability. 5. Stability. 1. High return. STP benefit investor to earn higher returns by shifting to profitable venture when market swings. 2. Optimal balance. In allotting investments from debt to equity and vice versa. This provide an optimal combination of risk and return. 3. Averaging of cost. STP involves investing in fund when their average price is low and sell them when market value increases. 4. Taxability. FATch transfer under STP is subjected to tax deduction. 5. Stability. Investors can transfer their fund to safe schemes when market is more volatility, which ensures safekeeping of investors' financo.